Episode 5, 50% and 80%. Probability, not prediction. By the time price reaches the 50% level, most traders think the trade is obvious. That's usually when the trade becomes dangerous. This episode is about correcting one of the biggest misunderstandings in trading. Levels do not predict what will happen. They describe how likely continuation still is. What the 50% level actually represents. The 50% level is not mid-range guaranteed continuation proof the trend is strong. The 50% level represents statistical follow-through. It means price has moved far enough from equilibrium that participation is no longer casual. One side is now working harder to keep the auction moving. Risk begins to shift. Think of 50% as the point where continuation is possible, but no longer cheap. Most clean trades start before 50%. Most exits should happen into or near 50%. Why late breakouts? Fail at 50%. This is one of the most common retail mistakes. You miss acceptance at 20%. You buy strength into 50%. Your stop goes under EQ. Price rotates. Confusion follows. The market didn't trick you. You entered after the informational edge expired. At 50%, you are no longer trading intent. You are trading exposure. 80% is not a target. It's a warning. This is where Harmonia completely diverges from standard tools. 80% does not mean price will go there, this is the final target, the trend is confirmed. 80% means the auction is approaching exhaustion. At this depth, marginal buyers and sellers enter, professionals reduce risk. Continuation requires urgency, not participation. This is why breakouts often stall here. This is why fades begin to make sense. This is why failed auctions are common. Why strong trends still reach 80%. Strong trends can reach 80%. But notice what's different. Acceptance happened early. Pullbacks were shallow. Equilibrium was never reclaimed. 80% becomes reachable only because the structure beneath it is healthy. Without that structure, 80% becomes a trap. The hierarchy of probabilities. Harmonia does not tell you where price will go. It tells you where continuation is likely, where risk increases, where fading becomes logical. Think in layers. 20%. Is continuation even allowed? 50%. Is continuation still efficient? 80%. Is continuation becoming fragile? Each step increases exposure. Each step demands more discipline. Why 100% exists and why you rarely trade it. The 100% extension represents historical extremes. It answers one question. Has price ever been this far from equilibrium before? When price approaches 100%, structure is usually complete. Continuation. Trades are poor, only specific failure setups make sense. This is not where you chase. This is where you protect. Probability, not certainty. Most tools lie by implication. They draw levels and silently suggest price will react here. Harmonia doesn't do that. It shows how far price has traveled relative to history, how much risk you're taking right now, whether you're early, late, or gambling. That's not exciting. It's professional. What comes next? You now understand the ladder. EQ 20%, 50%, 80%, 100%. But knowing the ladder isn't enough. What matters is how price behaves at these zones. In episode 6, we'll break down auction outcomes, successful auctions, failed auctions, rotations, and how classic setups like turtle soup fit naturally inside the Harmonia framework.